The Amplify Enhanced Dividend Income ETF DIVO is an actively managed exchange-traded fund that seeks to provide investors with a combination of current income and capital appreciation. Launched in December 14 of 2016, DIVO employs a unique investment strategy that combines a portfolio of high-quality, large-cap, dividend-paying stocks with a tactical covered call writing approach. Now, this strategy aims to generate income through dividends as well as option premiums while offering potential for capital appreciation. Now, if we take a look at DIVO, it has high income potential. So you're not only going to receive high quality dividend oriented stocks that are paying you dividends, it's also going to write covered calls against those stocks to generate additional income. And because of the options that it's going to employ, it is actively managed. So we are going to see a higher than normal expense ratio than the passively managed fund. But for an actively managed fund, 0.56% is really not that bad compared to some other covered call ETFs which have expense ratios of over 1%. And with this fund, we're seeking to lower volatility. So this is very good for this type of market where it's very volatile and very uncertain. So dividend and option income may provide lower share price volatility versus the overall market during times of broad-based market declines. So this is definitely an ETF that you should consider adding to your portfolio, especially if you want to reduce your volatility while still providing yourself with option and dividend income. And if we take a look, it actually has a 5-star Morningstar rating. So it's a very solid and proven ETF, as it's been out for nearly a decade now with a strong track record. DIVO is an actively managed ETF of high-quality, large-cap companies with a history of dividend growth, and the strategy is designed to offer high levels of total return on a risk-adjusted basis. Now, compared to some of the other dividend stocks and ETFs out there, this one pays out monthly, and with that monthly distribution frequency, we're getting a nice dividend rate of 4.85%. which is significantly higher than something say EHD, which only has a current dividend yield of around 4%. And that monthly dividend payout is going to be very attractive to a lot of investors. Now, if we take a look at some of these funds holdings, we can see the top 10 holdings consist of about 20 to 30 large cap US companies known for the consistent dividend payments and strong fundamentals. The top 10 holdings are going to be Caterpillar, Visa, American Express, Microsoft, Goldman Sachs, CME Group, JP Morgan Chase, Home Depot, Meta, and International Business Machine Corp, IBM. So very solid holdings, and a lot of these are dividend paying stocks, which is going to assist you with that monthly income. These companies are typically leaders in their respective industries, which offers stability and potential for capital appreciation. And in addition to holding these dividend-paying stocks, DIVO tactically writes covered call options on select positions within the portfolio. This means that the fund sells call options on stocks it already owns, which generates additional income through option premiums. So the strategy can enhance the fund's income, but may cap the potential upside of the underlying stocks if they appreciate significantly. So by combining these strategies, DIVO aims to provide a total return with an emphasis on high current income and the potential for capital appreciation. And if we take a look at DIVO's selection methodology, how they choose their portfolio holdings, it's going to choose companies that have dividend growth. DIVO is managed with a strong emphasis on owning high quality large cap companies with historical dividend and earnings growth. We also have sector allocation. So DIVO is relatively balanced among traditional 10 S&P 500 sectors, with CWP determining which sectors to over or underweight based on various factors. And of course, we have security selection. So the fund consists of 20 to 25 stocks, which are screened and adjusted according to attributes including market cap, management track records, earnings, cash flow, and return on equity. And of course, we have the actively managed portion of this ETF, which is the covered call writings. So covered call options are written on individual stocks on a tactical basis. And if we take a look at the sector allocation as of December 31st, 2024, the majority of this ETF is actually going to be in the financials. as well as the industrials and healthcare as the top 3 sectors. But we can see we're very diversified within the sectors. We also have consumer discretionary, information technology, communication services, and energy as some of the other top holdings. Now, if we take a look at the past performance, in the past month, we're actually down almost 4%. Now, compared to the S&P 500 index, so we're going to be using SPY for this example, that is almost down 5%. So we can see in share price alone, it is a little less volatile than the S&P 500 overall index. And that is not taking into account this 4.92% dividend yield that it is currently providing. So if we take a look at the total returns, now this is with dividends reinvested, we can see that DIVO is only down 2.47% in the past year to date, compared to the S&P 500 index, which is down 7.41%. So if you're looking for a less volatile investment, DIVO is going to provide you with that monthly income, providing a 4 to 5% dividend yield, as well as the room for capital appreciation. Now, of course, because it is selling covered calls and it has some more stable dividend stocks, when the market shoots up, it is not going to see those gains as big as the overall market. So the past day, it is up 6% compared to the S&P 500 index, which is up 10%. And that really is part of the trade-off of investing in dividends and option income investments. It's for people who want less volatility. They want a more stable portfolio and have reliable income, especially since DIVO pays out dividends on a monthly basis with a dividend growth rate of around 12%. Now, if we take a look at the dividend history, it's paying around 16 cents per share with a share price of around $40. So where DIVO really shines is in flat markets, or really in bear markets, where the covered call options are going to help prevent a little bit of that downside risk because you're collecting the option income. But because we're holding underlying stocks, the best market for DIVO is when the market is going steadily up, because we do have room for some upside potential. Now, if we take a look at the all-time total returns with dividends reinvested since 2016, it is up 84%. That is a solid return for just 8 to 9 years of holding. DIVO may be suitable for investors who are seeking regular income. The fund's focus on dividend-paying stocks and covered call premiums provides a steady income stream, which is very appealing to income-focused investors. It is also perfect for people who have a desire for lower volatility. The market is very volatile right now, so the covered call strategy can offer some downside protection, potentially resulting in lower volatility compared to the broader market. And this is also suitable for investors who have a moderate risk tolerance. So while the fund aims to reduce volatility, it still involves equity market risks and may not be suitable for highly conservative investors who would prefer bond ETFs. Now, when evaluating DIVO, it's helpful to compare it with other ETFs employing similar strategies. One of them is going to be the JP Morgan Equity Premium Income ETF, JEPI. Both funds utilize a covered call strategy to enhance income, but they differ in their approaches and underlying holdings. For instance, JEPI holds approximately 100 stocks and uses the equity-linked notes for its option strategy, while DIVO focuses on a more concentrated portfolio with tactical call writing. And many of the holdings in JEPI is going to be on the S&P 500 index. And we can see the weight is no more than 2% in any stock, compared to DIVO, which only has between 20 and 30 holdings, and some of the holdings can go as high as 5%. So the Amplify Enhanced Dividend Income ETF offers a unique blend of dividend income and option premiums through its covered call strategy, aiming to provide investors with regular income and potential for capital appreciation. Its diversified portfolio of high-quality dividend-paying stocks, compared with tactical covered call writing, makes it an appealing option for income-focused investors with moderate risk tolerance. As with any investment, it's crucial to assess how DIVO aligns with your individual financial goals and risk tolerance. And because of all these reasons, this is the perfect ETF to invest in right now if you're looking to withstand this extreme market volatility.